Hello, pembelajar online whom I love wherever you are. So today we would like to discuss about working capital. But before that, please subscribe, share, comment, and also like my YouTube channels. My name is Dadang Prasetyo Jatmiko. I'm a PhD graduate from Cardiff Metropolitan University in the UK, and I'm an expert in financial area. Please stay tuned and we'll be right back after this moment. Alright, ladies and gentlemen, so let us begin our discussion for today. So, we'll talk about working capital, its definition, concept, types, benefits, uses, management, and turnover. Actually, there are two main concepts in working capital. The first one is net working capital, and the second one is gross working capital. When an accountant uses the term working capital, it usually refers to net working capital, which is the dollar difference between current assets and current liabilities. This is one measure of the extent to which a company is protected from liquidity issues. Judging from a management point of view, it makes little sense to talk about trying to achieve manage the net difference between current asset and current liabilities, especially when the difference is constantly changing. Financial analysts, on the other hand, actually always talk about current asset when they talk about working capital. Therefore, their focus is on gross working capital. Since it makes no sense for financial managers to be engaged in providing an effective amount of current asset to the company around its entire time. In this case, we will adopt the concept of gross working capital. As we discuss working capital management, our concern is to consider the management of the company's current assets, namely cash and securities, receivable and inventories, and the funding, or especially current liabilities necessary to support current assets. So first, we talk about the importance of working capital. The management of working capital taken in this chapter and the next three chapters is of important value of several reasons. For one thing, the current asset of manufacturing company typically cover more than half of its total asset and even more for distribution companies. An excessive level of current asset can easily lead to the company realizing a not smooth return on investment. However, companies with too few current assets can cause shortage and difficulties in maintaining smooth operation. For small companies, current liabilities are the main source of external funding. These companies do not have access to the long-term capital market. On the other hand, to obtain a mortgage or a debt instrument with the granting of independent right to property and borrowers to lender as collateral for a building. Companies that are growing rapidly or even already large companies are also taking advantage of the funding that is accountable at this time. For this reason, financial managers and staff devote most of their times to working capital matters, the management of cash, securities, account receivable, account payable, accruals, and other means for short-term financial is the direct responsibility of financial managers, inventory management only. In addition, this management responsibility require constant daily supervision. Unlike dividend distributor decision and capital structures, companies cannot study these issues to make decisions and set the problem for the next few months. Therefore, the management of working capital is important. If there is no other reason than the proportion of time of the financial manager that should be devoted to it. Even more fundamental is the effect of working capital decision on the risks, return, and share price of the companies. And then we talk about probability and risk. The most basic working capital management is two fundamental decision problems of the company. There are determinants of the optimal level of investment in current assets. The right mix of short-term and long-term fundamental funding can be caused and used to support investment in current assets. In turn, this decision is influenced by a trade-off, or a balance is reached between two desired things, but in fact, the balance is not right or compromised. That must be adjusted between capability and risk. Lowering the level of investment in current assets while still supporting sales will lead to an increase in the company's total return on assets. To the extent that the explicit cost of short-term financing is lower than that of medium and long-term investment. The greater the proportion of short-term debt to total debt, the higher the company's probability. Although short-term interest rates sometimes exceed long-term interest rates, they are generally lower. Even when short-term interest rates are higher, the situation tends to be only temporary. Over a long period, we expect to pay more interest costs with long-term debt than we would get with short-term loans, which continue to roll on an ongoing basis and are always struggling with maturity. In addition, the use of short-term debt as opposed to long-term debt tends to generate higher returns because the debt will pay off during period when it is not needed. These favorable assumptions advise us to maintain low-level current assets and the proportion of current assets and the proportion of existing current liabilities to the number of existing liabilities. The strategy will result in a low level of net working capital or a negative probability. Offsetting profit through this strategy, however, will contribute to an increase in risk for the company. Here, risk means a danger to the company for not maintaining sufficient current assets in order to, first, fulfilling its cash obligation when it happens, then support the right level of sale, for example, inventory shortage. Also, the second one, we are talking about working capital component. Before turning our attention to working capital should be financed, we need to do a little detail or classify working capital. After establishing working capital as the current asset, it can now be classified during its assets, such as cash, security, receivable, and inventory. Although the working capital component is clear enough, time-based classification requires some explanation. The permanent working capital of a company has the number of current assets needed to fulfill the minimum long-term needs. Companies can call this working capital a bare bones, or reduced to or consisting only of the basic of essential element of something. Temporary working capital, on the other hand, is an investment in current assets that vary according to seasonal needs. Fixed working capital is the same as fixed assets of the company in two important aspects. First, dollar investment in the long term. Despite the contradiction that the financed assets are called current, second, for the growing company, the level of permanent working capital required will increase over time in the same time and the same ways as well, with which the company sets asset will need to be increased over time. However, fixed working capital differ from fixed asset in one very important point: this will constantly change. Take a can of red paint and trim some of the company fixed assets, such as factory and equipment. If the company returns with a month, the same asset will exist and remain there, and they will still have a red color. Now, paint the company's money, bill office, and supplies with a green color. If the company returns in a month, this company may still find some item with green color, but many, perhaps also some, will be replaced with a new item that are not painted or not in green. Thus, fixed working capital does not consist of current assets that remain in place, but is a fixed level of investment in current assets, the goods of which are constantly rolling. In other words, working capital is likeness to the level of water that the company finds in a bay of low tide. Like fixed working capital, temporary working capital also consists of current assets in a constantly changing forms. However, since the need for a share of the company's total current asset is seasonal, we may want to consider measuring the level of this current asset from a source that can be utilized and is seasonal or temporary in nature. Finally, let us direct our attention to the problem of how to finance current assets. So third, we are talking about the source of working capital financing. The way a company's assets are funded involves speculating between risks or loss and profit. For the analysis, we initially assume that company has an established policy in connection with payment for purchases, labor, taxes, and other costs. Thus, the amount of debt and accrual included in current liabilities is not an active decision variable. They fund parts of the current assets of the company and tend to fluctuate with the production schedule, and in the case of accrual taxes, with the profit coming along as the underlying investment of current assets continue to grow, debt and accruals also tend to grow. In the part of asset development financing, our concerns is how assets that are not supported by spontaneous funding should also be addressed. This residual financing requirement relates to the net investment of assets after spontaneous funding has been successfully deducted. Then we are talking about hedging or investment to reduce the risk of adverse price movement on assets. If the company applies a hedging approach or maturity matching as financing, each asset will be offset by a financing instrument through the same maturity estimate. Short-term or seasonal variation in hedging will be financed with a short-term debt. The permanent component of current asset and all fixed assets will be financed with long-term debt or with equity. If the amount of the terms of the fund applies according to the means indicated above, only the short-term fluctuation indicated at the top of the figure will be financed with short-term debt. These reasons for this is that if a long-term debt is used to finance short-term needs, the company will pay interest on the use of funds when such funds are not needed. Financing will be used in seasonal periods or time lags if it is not needed, with a hedging approach to financing. The schedule of borrowing and payments for short-term financing will be arranged to match the expected dynamic changes in current assets, which are investment with less spontaneous period. But the reduce the number of spontaneous assets and the equivalent amount of current assets and also the maturity matching approach to financing suggests that despite the current installment flow for long-term debt repayment, a company will not show seasonal debt for asset needs. When the company switches to a period of seasonal asset needs, the loan will be borrowed on a short-term basis, then pay off the loan will cash related from the reduction temporary asset. For example, the expansion of seasonal inventories and receivable for the Christmas sale season will be financed by short-term loan. As inventory decrease due to sales, receivable will soon be built. The cash needed to pay off the loan will come from the collection of such receivable. All this will happen in a matter of few months. This way, financing will be carried out only when needed. This loan is also support seasonal needs by following the principle of self-liquidating, meaning such a loan is to generate the necessary funds for repayment in normal operation. And the term permanent asset will be financed with long-term debt and equity. In such a situation, the long-term asset that has been funded will return into a profit that will be calculated to cover the cost of long-term funding. In a growing situation, permanent growth will be continued to increase as the need for fixed asset increases. Then, we'll talk about short-term versus long-term financing. Although the accuracy in adjusting between the company's schedule of net cash flow in the future and that repayment schedule is per the certainty that will occur with the company, there is usually some time wrong because there are uncertainty factors that are difficult to predict. Net cash flow will deviate from the expected flow following the company's business risk. As a result, the maturity schedule for debt fulfillment will be crucial in predicting the speculation of risks and profitability. The question is that what margin of safety or toleration should be built into the maturity schedule to allow adverse fluctuation to occur in cash flow. This actually depends on the management's attitudes to speculation between such risk and profit. Then we talk about relative risk engagement. In general, the shorter the maturity schedule of the company's debt obligation, the greater the risk that the company cannot fulfill the principal and interest payments. Suppose the company borrows in a short period to build a new plant. Cash flow from the plant will not be precise enough in the term to pay off all loans. As a result, the company bears the risk that the creditor may not be running or renewing the loan of maturity. These risks or refinancing for the future can be deducted or anticipated from the very beginning of the implementation of the strategy by financing the plant on a long-term basis or future cash flow or for a long-term period that is expected to be sufficient to pull debt in an orderly manner or that is easier to pay regularly. Thus, funding long-term assets coupled with short-term loan carries a huge risk that the company may not be able to renew its loans in the future. If the company has to felt and difficult of times, creditor may find renewal too risky because it will be very difficult to demand immediately payment. In turn, this will be burdensome for the company. Other ways may be used as an alternative such as selling assets for cash or blatantly declaring bankruptcy. In addition of the risk of recapitalization, there is also uncertainty associated with interest costs. If the company has long-term debt, it must know exactly the cost of interest during the period it needs against the funds. If there is a short-term debt, it is not certain how much interest is needed in recapitalization. In a true sense, the uncertainty of interest costs is a risk for the borrower. We know that short-term interest rates fluctuate much higher than long-term interest rates. A company that is forced to return its short-term debt in the period when there is an increase in interest rate can pay the overall interest cost for short-term debt, which is calculated against the amount is higher than it should be, and it is better to take long-term debt. Therefore, not knowing the cost of short-term loan is the risks and the future big risks for the company. So we talk about risks versus financing trade-off. The risk difference between short-term and long-term funding should be offset by the difference in interest costs. The longer the maturity schedule of the company's debt, the more expensive the financing will be. The total number is also increased. In addition, the generally higher cost of long-term loans, the company will probably pay interest on the debt during a period when funds are not needed. Thus, there are cost stimuli for carrying out this requirement of short-term financial funds. As a result, we have a trade-off or uncertainty between risk and profit. We have seen that in general, short-term debt has a greater risk than long-term debt, plus also lower cost. The safety provided by the company can be considered as a lag in the net cash flow that the company estimates the payment under the contract on its debts. This security margin will depend on the risk management requirements. In turn, management's decision on the maturity composite of the company's debt will determine the portion of current assets financed by current liabilities and other parts financed on a long-term basis. To decide on the margin of safety, management can decide on the proportion of long-term and short-term financing. Here, we can see that company finance part of the expected seasonal needs of funds, a small amount of debt, and accrual for the long term. If the expected net cash flow occurs as expected, it will pay interest on the excess debt over a period of a given season when the special funds are not needed. In the extreme, peak requirements will probably and entirely in the long run, as would be the case if we draw a long-term financing line across the graph. The higher long-term financing line, the more conservative the company's financing policy and the higher the cost. In contrast to the conservative financing policy, or a longer maturity schedule, here we can see that is a negative margin of safety. The company has financed some of its fixed asset with short-term debt. As a result, we had the restructure of this debt as a maturity, and this involves an element of risk. The greater the portion of the needs for fixed assets financed with short-term debt, the more aggressive the finance that must be covered. Therefore, the accepted safety margin associated with the company's policy regarding its mixed short-term and long-term funding may appear positive, negative, or even zero. A zero value occurs as the result of cases that arise in the hedging policy. The company can also create a margin of safety by increasing its liquidity assets. Thus, the company can reduce the risk of cash bankruptcy either by raising the maturity schedule or its debt or by carrying a large number of short-term or current assets. Long story short, we can explore the independence of these two aspects. Note that maintaining a short-term funding policy for short-term or temporary asset needs and long-term funding for long-term or permanent asset needs will require a set of medium-risk profitability strategies. What we have done about a maturity matching approach to financing. Other strategies are possible and should not be considered wrong. However, what the company gets by the following alternative strategies needs to be considered against what the company already considers not to be done. So that's the things about working capital that I can summarize and send it to you. and we will be back very soon, and we will also talk about another thing. Assalamualaikum warahmatullahi wabarakatuh.